Hey, welcome to What the Tech. This is the show that cuts right through the noise. So today we're looking at something that's being peddled as the next big thing for homebuyers, a real dream come true. But, you know us, we're going to dig in and see if it's actually a total nightmare in disguise. Let's do this.
So, you've probably seen this making the rounds. The big new idea being floated is the 50-year mortgage. Yep, you heard me right, 50 years. It's being sold as a complete game changer for making homes affordable. I mean, the pitch is pretty simple, right? Just stretch the loan out over half a century, and poof, your monthly payments get a little smaller.
But is it really a game changer? Or is it something else entirely? Like, say, a financial trap? That's the real question here. Is this thing actually designed to help you, the home buyer, or is it set up to make somebody else rich? Well, we're about to find out. All right, to really get to the bottom of this, we've got to forget the hype, forget the headlines, and just run the numbers. And let me give you a heads up right now. What we found is not pretty. The math on this thing is, well, it's brutal. Okay, so let's use a pretty standard example. Say you're taking out a $500,000 loan. With a normal 30-year mortgage, your payment is going to be around $3,068 a month. Now, with a 50-year loan, and notice it has a slightly higher interest rate, your payment drops to $2,985. So yeah, it's lower. But is it really? Yeah, let's look at what that lower payment actually gets you. You're saving $83 a month. That's it. For adding 20 years to your debt, you get $83? I mean, come on, that's not a game changer. That's maybe a couple of pizzas, a tank of gas if you're lucky. It's basically nothing. Okay, but here's where the trap really springs shut. The real cost isn't in the payment, it's hidden in your equity, the part of the house you actually own. So check this out. After 5 years of payments on a 30-year loan, you've paid off over $33,000 of the actual loan. But with a 50-year mortgage, you've barely paid off $7,000. You're almost exclusively paying interest. You're basically just renting money. And if you thought that was bad, get ready for the knockout punch. Let's fast forward 30 years. 3 decades of making payments every single month. At this point, the person with the 30-year loan is done. They own their house free and clear. But you, with the 50-year loan, you still owe almost $387,000. After 30 years, you've barely touched the principal. So let's just lay it all out, side by side. It's just brutal. The 30-year path gets you to zero debt, you're a homeowner. The 50-year path, after 30 years, you're still crushed under a mountain of debt that's almost as big as what you started with. The difference isn't just big, it's staggering. Look, the numbers do not lie. And here at What the Tech, we don't either. This is what we do. We cut through the hype and show you the reality. So if you want more of this kind of analysis, you know what to do. Hit that subscribe button right now, because this is the stuff they don't want you to know. Okay, so the numbers are shocking, right? But what does this actually mean for you as a homeowner trying to build a future? Let's talk about the real hidden cost here, because it's not just about the money. It's about how your ability to build wealth just vanishes. You see, one of the best things about a regular mortgage, the real magic of it, is this idea of forced savings. It's simple. Every time you make a payment, a piece of it goes to paying down your debt. You're converting that debt into equity, into actual wealth. It's like an automatic savings account that you can't touch, and it's a powerful wealth-building machine. Well, the 50-year mortgage takes that whole concept and just kills it, dead. It's basically an interest-only loan in slow motion. For decades, almost all of your money is just going straight to the bank's bottom line. You're not building your net worth, you're just padding theirs. You're basically a renter with a mortgage. And that's the trap. You're stuck. Think about it. You build wealth so slowly that you can't even afford to move because realtor fees and closing costs would wipe out the tiny bit of equity you have. If house prices dip even a little, you're instantly underwater, and refinancing to a better rate, good luck with that. This isn't just a trap for you, it makes the whole housing market more fragile. So this all begs a pretty obvious question, right? If this is such a raw deal for you, the borrower, then who exactly is this supposed to benefit? Why is anyone even talking about this? Well, you know the rule. Follow the money. And here we have it, the winners and the losers. The winners, well, politicians get to put out a press release saying they tackled housing affordability without actually doing anything hard. And the banks, oh man, they make out like bandits collecting interest payments from you for an extra 20 years. And the loser?
Well, that's you. You get a tiny bit of monthly relief in exchange for a lifetime of risk and almost no wealth creation. You know, the most frustrating part of all this is that there are better ideas out there. This 50-year mortgage thing, it's just a Band-Aid on a bullet wound. It's a gimmick. There are real, actual solutions that could fix the problem without destroying the entire point of homeownership. I mean, how about we actually build more houses by reforming zoning laws? That would tackle the supply problem head on. Or what about offering real, targeted down payment help for people who need a leg up? Or using responsible ways to buy down interest rates for a few years. We could even change how loans are approved to look at the total cost of owning the home, not just a misleading monthly payment. These are things that actually work.
So what's the bottom line here? The 50-year mortgage is not a game changer. It's a trap. It's a gimmick that asks you to trade the single most powerful wealth-building tool you have, your home equity, for a monthly discount that barely even registers. This doesn't solve the affordability problem. All it does is, and I quote, lengthen the fuse on a larger debt bomb. And that's something we should all be worried about.